I'm going to be talking about the breakout day trading strategy in this video. I'm going to go over some of the details about this strategy, what it's looking at. We're going to look at some performance reports, and then I'm also going to look at or kind of show how we get our stop on this trade, and then what happens if you hold it an extra day, and what happens if you use a limit order. So just a few of the modifications that I have looked at with this strategy that we're not currently using. This strategy is traded in the majority of our portfolios, the day trade, the ESTY, and the S&P Crusher. It's built to outperform in upward moving markets. And with that in mind, let's go ahead and go to the disclaimer. Okay, so first I would like to go over our disclaimer. We are not registered with the CFTC as a commodity trading advisor. We are what's called a third-party developer. We create algorithms and we license them for use on a personal computer through TradeStation, and they can also be auto-executed through NFA-registered brokers. Keep in mind that trading futures and options involves substantial risk of loss. These algorithms are really not for everyone. They should be traded with risk capital only, in our opinion. And lastly, the data that we show, unless otherwise noted, is based on hypothetical back-tested models, and it does have certain limitations per the disclaimer here. So feel free to read this. You can pause the video and read it more carefully. The last comment I'll make is that the data is for educational purposes only. Again, because we're not registered, we do not control client accounts. And also, I guess I should mention that because we're not registered, the data that we show has not been audited by any government agencies. So just keep all that in mind as we go through the data in this video. We're going to be talking about performance. Again, that's based on hypothetical back-tested models. It does have limitations. At times we do mention the live returns on the website or in the video, and when we do, that is from live data, and we note it as such. When we do that, just again keep in mind that past performance is not indicative of future results, and again, trading futures does involve risk of loss and is not for everyone. Okay, so this is a chart of the S&P 500 E-minis, and it is a 9-minute candle chart, meaning each candle is set to 9 minutes. These little dotted lines you see here, these gray ones, those separate the different days. I'd also like to mention that the futures do trade 24 hours for the most part, with about an hour break. And the way that this algorithm trades is it only trades when the equity markets are open, and so we have a session set that kind of constrains the time that's shown on the chart. So what I'm going to do right now is I'm going to go ahead and enable the breakout strategy so that you can kind of see the trades populate on the chart. And so right now TradeStation is calculating the trades, and it just added all the trades onto the chart in the back testing. Okay, so first I'd like to look at an example of a really good trade that this one had. So what this algorithm does is it is a day trade, meaning it's in and out the same day. It's basically looking to buy on strength in the morning and then get out at the close. It does not have a target, meaning it will hold the entire day unless it's stopped out. So it does have a stop that's in place when we're in this trade. But here's kind of a typical example of a really good trade that this algorithm might have. And what you're looking at is kind of at the beginning of November and the end of October, the markets were going lower, as you can kind of see in here. And what can happen with this trade is on a day like the 7th of November, which I believe this was the election day when the market gapped up, you can have a lot of strength in the morning, and what'll happen is this algorithm will get in the trade, and then it will hold until the close and then get out. And usually the best trades on this algorithm are after we've had kind of a down move, and then at the start of what might be kind of a new bull run where the markets go higher. And so this is again a good example of a winning trade that this one had. We got in at 21.13 and got out at 21.29, so it's about a 16-point gain on the S&Ps, which is each point is $50, so that's about a $800 to $900 gain on this trade right here. Now, of course, it doesn't always work that way, and sometimes we do get stopped out of the trades. And so let's look at an example where that happened, and then I want to show you kind of the performance reports. So here's a trade where we got in on this kind of gap higher, and then the market was strong the first 20 minutes, so we got in, and then we got stopped out kind of shortly after. This stop on this algorithm is set to $350, and so it can happen where it does get stopped out. But now that we've kind of looked at a few of the trades, and again, just to reiterate, it gets in 18 minutes after the market opens, and then gets out at either the close or when we're stopped out. So let's go ahead and look at the performance reports now. What I just did is I kind of zoomed back in time a little bit just to see or just to show some of the different periods of trade history, and what this shows is that as the chart goes back to 08 and 07 all the way back to 03, what TradeStation does is it adds the algorithm to all these different periods, and that's what's called kind of our back-tested hypothetical account returns. And so really it gives you all the trades that this algorithm would have placed in the back testing had it been trading at that point. Now, keep in mind that trading or backtesting does have significant limitations for the disclaimers that we have. But once you have the algorithm loaded, and this is one of the advantages of kind of algorithmic trading, is that it does give you kind of an idea of how the algorithm performs, or how it would have performed in that backtested period had it been trading live with all those disclaimers. The profit factor of this algorithm is at 1.40. That's the ratio of gain to loss. The win rate is about 50%, and the total number of trades in the back testing is 506. And so these reports give you quite a bit of information. It gives you the drawdown of $3,096, and so that's if this algorithm was trading alone, not as part of a suite of portfolios, then this drawdown would help guide kind of how big of an account is needed to trade this algorithm. And just remember that because it's a day trade, it does not require any overnight margin, and so most brokers allow a lower day trade rate, which means that this algorithm is kind of free for us to trade in the portfolios that we have, because we don't need to have extra capital in order to trade this algorithm, because for example, in the S&P Crusher, it's a $30,000 unit size, and so that's plenty to handle this algorithm plus the other ones that are traded. And so it's one of the advantages of the day trade algorithms is that they really don't require extra capital. Also, as you probably heard me mention before, because it doesn't hold overnight, there's less risk in general due to potential geopolitical events that might happen and cause the markets to drop. Here's the equity curve, and so you can see it's a real nice kind of steady higher equity curve. And so again, this algorithm is a day trade. It's one of the longest running ones we have, and it does trade the S&P E-minis. So here's just the trade list, and I guess this report actually goes all the way back to 01. But what I'd like to do now is kind of go through a few changes just to show you how it impacts the performance report. So if we look here at this strategy as it is right now, it has a $350 stop. The use profit target is set to false, meaning it ignores this target right here, which would be a dollar amount. And we have exit on close set to true. What I'd like to do is show you what happens if we change things around a little bit. And the reason why I'd like to do that is because a lot of times when we get into this trade, sometimes the market will go higher and then it will sell off a little bit, and the question usually, always comes up. Well, why didn't we get out when it was more profitable? Why did we hold on and then get out at a lower price at the close? And the reason why is because the stop, whether or not to use a limit order, whether or not to get out at the close or hold it for a few days, that's all driven by the data from the back testing. And so if for example, if I let me go ahead and just do this. Let me change the profit target to true. So what that means is instead of getting out at the close, what we're going to do is we're going to get out if we have either a $350 gain or the market closes. So whichever comes first, but it'll also use the stop. So I just want to show you what that does. Remember the profit factor before I made this change was 1.40, and now that I made that change, so it recalculated the strategy, and now we'll look at the performance report. And so what it's doing is it's just recalculating everything, and you can see that the profit factor dropped down quite a bit, and so that's just kind of a real basic example of why we don't get out when it has a $350 gain, is because in the long run the performance is not as good. So what I'll also do is make another modification. What I want to do is give it a profit target, but it's going to be a pretty big one, and we'll use $1,000, and I'll show you what that looks like. So you might say, well, 350 doesn't work, but what if we had a bigger target? And what you'll see is that as the target gets bigger and bigger, the profit factor kind of approaches our 1.4 a little bit more each time. And so, with the $1,000, it gets a little bit better, but it's still lower than the 1.4 that we had. And so what I'm saying is if I made this really big, so like, I don't know, let's just say 5,000, that's pretty much the same as not having a target, because it probably never actually hits that in a day. And so generally speaking, the bigger the target, the better. Now, the next thing I want to show you is what happens, or why we get out at the close, because you might ask, why not hold on for a few days if this is kind of going to be the start of a new big rally? Why not get in, have a target of maybe $1,000, a bigger target, but then if it doesn't hit it, hold for a few more days to see if it can hit that. And so what I'm going to do is set exit on close to false now and show you what that looks like. Okay, so now what we've done is we have a $1,000 target, but instead of getting out at the end of the day, it's going to hold for multiple days to see how that does. And back here is actually a good example of a trade where that would have worked. I think this is the first trade we were looking at, where before it got out at the close, now it holds an extra day, but it tries to get a $1,000 gain. And if I look at the performance report now, you'll see that that it actually dropped down quite a bit. So it went all the way down to 1.09. And so what that tells us is that holding an extra day just in general is a bad idea, because if you remember, if we still get out at the close, the profit factor was 1.33, even if we have that $1,000 target. Simply by holding on to the trade for multiple days until that $1,000 is hit, the profit factor drops way down to where it's an algorithm that wouldn't be tradable. So the point of me doing all this is just to show you that we let the data kind of decide how we trade these algorithms. It's not based on just how I feel, or I don't pick these numbers out of thin air. The stop, for example, we actually optimize so that the simulations can tell us what the most optimal stop is. And we look at a lot of different scenarios with all these strategies, and it just so happens that this day trade algorithm, the Breakout, it's best using a stop of 350. It's best to not use a profit target, and it's best to make sure that you get out on the close as opposed to holding for multiple days with the target. So I'm going to change it back to the original and just kind of show you that one more time. So now we're back to how it's currently traded with what we feel are the most optimal settings. And if we look at so now we're back to the 1.40 with 28,000 total net profit, going back to 01, and that's assuming one contract is traded. We do model in slippage and commission into all of this data that we have here, and I think that summarizes the things on the charts that I wanted to show you. So now I'm going to go back to the slide deck and just talk about how this algorithm helps out with with all the different portfolios that we offer. Alright, so now at this point we've looked at the chart, we've looked at the performance reports. I've shown you kind of why we get out at the close, why we don't hold an extra day, and why we don't have a target. What I'd like to do now is just talk about how this trading strategy contributes to this suite of 7 that we have. Now, again, if most of you are probably at this point familiar with this way of looking at the data, where we have how the algorithm does based on if the market is going up, sideways, or down. If you want more information on what we're talking about here, I recommend you watch our design methodology video, where I go in quite a bit of detail on what the purpose of this is and how we come up with these different numbers. But really our design methodology is to not try to have one holy grail algorithm that does good in all market conditions, but to have multiple ones that trade concurrently, where each one has a different strength and then also weaknesses. So with this breakout algorithm, it happens to do best in months where the S&P closes higher by 30 points or more, which is how we define this up period here. And a sideways would be if the market was down between 4 points and up 30 points, and then a down is if the S&P for any given month closes down by 4 points or more. I just want to be clear that this doesn't mean that we guarantee every month this algorithm will make this much if that happens. It's more of an analysis based on the back testing, where we look at the previous 13 years and categorize the market into slices of a third. So a third of the time the market closed up 30 points or more, a third of the time it was between -4 and 30, and then a third of the time down by 4 or more. And so what that does is it lets us evaluate each strategy to see how we might expect it to perform in each of those kind of categories of how the market is doing for any given month. And so with the breakout, it does its best in months where the S&P closes higher. These other conditions where the S&P closes lower or sideways / kind of drifts higher, it doesn't do as well. And I also want to just mention that this algorithm standalone is one that probably most people wouldn't have an interest in trading, myself included in some ways, just this algorithm alone. But when you add it to a suite of 7 algorithms, then it kind of adds to the performance in the up market condition, and it doesn't take away in the sideways or down, and it doesn't really require any extra money in the account as well if it's traded in one of the portfolios. This unit size here, the 10,000, that's if you wanted to trade this algorithm just alone. That's just kind of the unit size that we put it at. But again, these day trade algorithms are essentially free to trade in the portfolios that we have, because we already have plenty of margin to cover them. So whether we trade the breakout or not, we still require 30,000 as a starting unit size in the S&P Crusher, and so that's kind of why we have this breakout day trade. It's also, you could also look at it as kind of combining the other 2 day trades and then the performance impact is a little bit higher, where all 3 day trade algorithms together kind of start adding more as a percentage to the performance. But this algorithm was really designed for up moving markets and also down ones. When I first designed this algorithm, I was wanting it to be kind of a short covering rally algorithm, and then we're talking about 3 years ago now. Back when I first started the company, that was my impression of what this algorithm would do. Is it would do really well in short covering rallies, and then kind of okay in up moving markets. And that is true. It does do best in short covering rallies, but the overall average is when the S&P closes up by 30 points or more for any given month. That's when it does do the best. I think that's, for the most part, all I had on this algorithm. It's again, it's a day trade. Gets in about 18 minutes after the market has opened, and then gets out at the close unless the stop is hit. Just to recap, I kind of showed you the chart, I showed you examples, the performance report, how it fits into the entire suite of algorithms that we offer through the portfolios we have. Just want to emphasize again that trading futures and options involves substantial risk of loss. It's not appropriate for everyone. And I think with that, I'll sign off. So have a great day, and we'll talk to you again later. Bye-bye.